Welcome, everyone. Thank you for hopping on this webinar today. My name is Susan Grassli. I'm glad you're here. I am an attorney here at GBS Benefits, and I spend my time helping our clients understand how to comply with all the health benefits compliance rules. Today, as you know, we're going to be speaking specifically about the ACA 1094, 1095 reporting forms. Our agenda today will be as follows. I like to show everybody the agenda so you know what to expect. We have an overview, then we'll be talking about penalties, and then we'll be talking in detail about the 1094, 1095 forms. The overview and the penalties will take about half of our time, and then we'll spend some time in the details on the forms themselves. So let's just jump right into our overview right now in our ACA big picture. For context and history about why we're here today, in 2010, there were two different laws passed, federal laws passed, one within the week of the other, and collectively they are referred to as the Affordable Care Act. Now, the Affordable Care Act is a short version, or the ACA is a short version that's been called. There are lots of different names, but for today, I'll probably just say the ACA or the Affordable Care Act. There are multiple provisions in the ACA. Most of those provisions were phased in effective dates, but by 2014, about 4 years after the law passed, most provisions were in effect. And by 2020, all the remaining provisions that are effective are in effect. So generally, as some context, after a law is passed, certain departments within the federal government are assigned regulatory authority. Regulatory authority in this case for the ACA was assigned to 3 different departments: Health and Human Services, the Department of Labor, and the Department of Treasury. You may hear them referred to sometimes as the departments or tri-agencies or just regulators, but that's who we're talking about. But they are generally investigating compliance, they are assessing penalties and tax, and they're issuing guidance. And I want to spend a little bit of time on the guidance portion just for a minute. The guidance comes in a few different forms, but it's basically super high level information or instructions that are meant to help entities understand, stakeholders, people who have to comply, understand how to interpret and understand the particular law. So examples of this guidance could include, you hear about, oh, there are proposed rules that were just issued, or final rules, or interim final rules, or FAQs, or model templates, or forms and letters. There's a whole basket full of different ways we can receive guidance. But that guidance helps us better understand how to comply with the rules, because the rules themselves, as they're written in the books, don't give us all the information we need in order to know how to be in line and in compliance. For the ACA overall, I like to divide the ACA into 4 main sections. The 3 main sections that impact 1094, 1095 reporting are here on the right of our diagram here. But all 4 parts include individual shared responsibility or the individual mandate, employer shared responsibility or employer mandate, and the exchange, sometimes called the marketplace, and the subsidies or the premium tax credit is the technical name for them, that you can sometimes receive if you purchase insurance in the exchange. And then on the left-hand side is market reforms, and those are a lot. There are a lot of other provisions in the ACA, and I lump them all together in that bucket. Now, I talk about this because it helps to know that the 1094, 1095 forms give the regulators the information they need in order to regulate the individual shared responsibility, the employer shared responsibility, and the marketplace subsidies. So that's why we have them now. The employer mandate or employer shared responsibility is the generally high level, the mandate that says large employers, in order to avoid penalties, should offer affordable minimum value coverage to all their, at least 95% of their full-time employees and their dependents. The marketplace and exchange, again, is where individuals and families can purchase insurance and sometimes be eligible for subsidies. And the individual mandate is a law that is now a little bit different today, but on the books, it requires individuals to obtain health insurance for themselves and their families. So let's talk just a little bit about the forms themselves. We hear the forms 1094, 1095, but what does that actually mean? First of all, there are different variations of the 1094, 1095 forms. There's the A forms, the B forms, and the C forms. And sometimes we get confused about that. So I want to make sure we have that foundational information as we move forward today. So the A forms are completed by the exchange. And for those people who are purchasing, and they're given to people who are purchasing or have purchased insurance in the exchange. The B forms are completed by insurers and small employers that offer a self or level funded plan. And the C forms are completed by all large employers, regardless of how the plan is funded. So what is the difference between the 1094 form and the 1095 form? The 1094 form is basically a cover sheet. It's a cover sheet that gives information, general information to the IRS about the employer. It's only filed with the IRS. And like I said, it's like a cover sheet. The 1095 forms are the forms that each individual employee who is supposed to receive one receives. So an employer is going to be populating multiple forms 195. And those are furnished both to employees and filed with the IRS.
Let's talk a little bit about the difference between small and large employer reporting. We're going to talk about large employers, and we're going to talk about small employers, and then we're going to talk just a little bit about how you define them. But large employers, you need to understand that all large employers report. It doesn't matter how you fund your plan, whether it's self-funded, level funded, or fully insured. You need to file and furnish the 1094, 1095 forms, and you're going to be using the C forms. Small employers report, some of them, and some of them do not. If you are a small employer and you sponsor a self or level funded plan, then you do need to report. If you are a small employer and you sponsor a fully insured plan, you do not need to report. There is a very small exception to that. We'll talk about that in just a second. But if you are reporting in your small employer, you're going to be using the B forms. Okay, so here's the rare exception. If you are a small employer and you sponsor a fully insured plan, you do not need to report. However, if you are also sponsoring separately an HRA, that is considered a self-funded plan. So you need to report based on that. But even then, it's a rare exception. You're only reporting on an employee who is enrolled in your HRA, but it's integrated with their spouse's or partner's plan with another employer. If they are enrolled in your HRA and it's integrated with your plan, you don't need to worry about the reporting. Okay, so I like visuals. So hopefully those of you who like visuals, this makes sense just as an overall big picture, how to understand the A, B, C in forms and who is preparing those forms and where they go. The 1094B and 1095B forms go to the IRS, and the 1095B forms go to employees. If you're a small employer who's offering a self or level funded plan, if you're a large employer, your 1094, 1095C forms are filed with the IRS, and you also furnish the 1095C forms to your employees. You don't obviously give them the cover sheet. They don't need that. They just get their own individual form. So how is a large employer defined? A large employer is defined as one who employs 50 or more full-time employees plus full-time equivalents, and there's a way to calculate that based on the prior full calendar year. And there's an average of that. And remember, it's the prior full calendar year. Same thing with small employer. If you do the same calculation, but the average is under 50, then you're considered small. A little note here, it's really, really, really important that you calculate your size correctly. If you are on that threshold or you're wondering whether you're large or small, then you really need to understand the calculation rules. We have created a 4-step process. The first step helps you determine your size. And that resource or that step 1 toolkit has an actual calculator and an explanation of the rules so that you understand how to do it correctly. And if you punch in your numbers, it should punch out the correct average for you. But there are certain other rules that you need to be aware of. So for example, you may think you're small because you have 20 employees, but you are part of a control group. You are part of a control group if you have other entities that have a certain level of common ownership. If you are part of a control group, and together you add up all those employees and it is more than 50, then you are considered a large employer under this rule. So even if your entity is 20, if collectively as a control group you're over 50, you are considered large and you are exposed to and have the same obligations as a large employer, and you're exposed to those large employer penalties. So you want to make sure you understand the rules when you're calculating and make sure you understand who you're supposed to actually include when you're doing that calculation. So we have here in the next couple of slides a couple of tips that I have inserted here because they are common issues and common questions or common problems. The first tip is for small employers, and that is to make sure that when you are calculating, and if you use our toolkit, that you will be able to do this, but you are using data from the full prior calendar year. That means January 1st through December 31st of the prior year. And based on that prior average, you will not be considered large the following year. Look at this first example I have here. Calculate monthly average size using data from January 1st, 2023 through December 31st, 2023 to determine your size for 2024. If you are large for 2024, then you must file the 2024 file and furnish the 1094, 1095, 2024 forms that are due this year. Does that make sense? So you're dealing with 3 different years. You're dealing with 2023 data, you're large for 2024, and you file in 2025. I know this can be confusing, so I have another visual to help for this particular year. Do I need to file 2024, 1094, 1095 forms? Yes. If your data in 2023 tells you were large for 2024. Also threw this in too. It's just a nice handy dandy chart if you're struggling with this and want to make sure you understand when you are and when you are not considered large and therefore need to file. Here is a tip for large employers with fully insured plans. This is a common pitfall too. I often hear, oh, I talked to my insurer. They say they're filing the forms. Yes, they are filing the forms because they are obligated to file the B forms, but you separately have to file the C forms. So they're not taking over your obligation to file and furnish any forms. They're fulfilling their obligation to do the B forms, and your obligation, if you're large, is to file the C forms. So an individual or an employee will be receiving a B form and a C form if you have a fully insured plan. Yes, question. The question is, if you're part of a control group, do you file collectively or do you file separately? Yes, you file separately. Even though you use your numbers collectively to determine your size, you each will individually file your own 1094, 1095 forms under your own EIN number. For those of you who are large employers and you sponsor a self or level funded plan, you need to make sure you understand that when you are completing the 1095C forms, there is a section called Part 3, and you need to make sure you complete that. That Part 3 section is the equivalent of the B forms that the insurers are doing for fully insured groups. So the regulators made it convenient for you so you didn't have to do 2 separate forms. They just added that B form information at the end of the C forms. So you'll do Part 1, Part 2, like fully insured, but you also will do Part 3. If you have a fully insured plan, you're just going to complete Part 1 and Part 2. And we'll talk about that when we get into details, but I want to cover that initially up front. Okay. So that is our overview on the forms, and we're going to dive into furnishing and filing. I haven't always emphasized the difference between furnishing and filing. And with some changes that are effective starting this year, I want to make sure you understand the difference. In the regulations and the rules, it's all referred to as furnishing and filing. That's why I'm using those terms. It's a specific technical term. Furnishing refers to providing the 1095 forms to employees. And filing refers to submitting the 1094, 1095 forms to the IRS. So when we're talking about furnishing, we're talking about employees. When we're talking about filing, we're talking about, sending the information to the IRS. So we're going to divide this conversation in the next few slides between filing and then furnishing. First, filing due dates. That means filing or submitting to the IRS. The general deadlines in the code has a specific date, And the specific dates are February 28th if you're filing hard copies, and if you are filing electronically, it's March 31st. Now, if those dates fall on a weekend, just like your individual taxes, the date gets changed to a work day, right? Or work week day. So this year, the filing deadline for 2024 forms is February 28th if filing hard copies, and March 31st. So it didn't change this year, but sometimes it does. Filing, this is to the IRS, due date extensions. Just so you're aware, there is a possibility that you can file for a 30-day automatic extension so that you are not late, because if you're late, you could be assessed a late fee for submitting late. But if you want to do this, you need to know in advance. You must complete the form. It's called 8809. You can submit that form by paper or electronically, but it's usually an automatic 30 days. So if you file it, you've got it. And now we're going to move on to the furnishing. So the filing was with the IRS. Now we're going to talk about furnishing to employees. The general furnishing deadline, when dates do not fall on a weekend, is January 31st, but there is an automatic extension of no later than additional 30 days. So it used to be January 31st, and then you could file for a 30-day extension, but now there's an automatic extension of 30 days. So the furnishing deadline for 2024 is March 3rd. Now, here's the update, and this is an important update. When you are furnishing to your employees, you had these specific rules. You have to get it to them by this date and in a certain way. There is now an alternative reporting method, and it is as a result of something that passed and was signed at the very end of last year called the Paperwork Burden Reduction Act. And now, because of this, you have, as a large employer and a small employer, you have the option to choose to furnish only to employees who request a form. So before, you automatically had to give to all of the employees who were supposed to receive a form. And now you can choose that alternative furnishing method, which means you can say, okay, we're not going to automatically do this, but if we do this method, you need to follow the specific rules. And the specific rules include providing clear, conspicuous, and accessible, that's language from the rule, clear, conspicuous, and accessible notice that the 1095 form is available upon request, and also include in that notice an email and physical address where requests can be sent, as well as a phone number that they can call for questions. If you do this method and you are doing it only upon request, you have an obligation to make sure you get that form to that individual by no later than the general furnishing date or within 30 days of the request. So whichever one is later, you can use that method. Now, is there a furnishing due date extension? No, there is not a due date extension because of the automatic extension that's already been built in. So there's already an automatic 30-day extension. So you can't then ask for an additional one and don't need to have an additional one. So that additional one gives you, let's go back, that March 3rd. Now, there is some ambiguity about how that date, March 3rd versus January 31st, applies to the alternative furnishing method. And there is nothing that refers to anything other than January 31st, because we want to be precise. And until and if we see your original due date, if you're using the alternative method, is January 31st, not March 3rd, versus 30 days after request. I know that's a technicality and you're thinking, Susan, you're a nerd, but I have to be careful. So I'm not giving you wrong advice. Okay, information. So here's our handy dandy form matrix that will help you kind of wrap your head around the different due dates if you like matrices. Let's move on. We're going to spend a little bit more time talking about rules about furnishing, and then we're going to talk a little bit more about rules with filing, and then we'll move on. Which employees must receive a 1095 form from you? So we're not going to talk about the alternative method. We're going to talk about in the rules who should be receiving a form. So if you're a large employer, it's different than if you're a small employer. If you're a large employer and you're doing the 1095C forms for everybody, which is what you're supposed to do, all your full-time employees must receive a form. It does not matter whether they enrolled. It doesn't matter whether you offer to them. Every single full-time employee needs to receive a form. And Any employee who worked at least a month of full-time in the 2024 is considered somebody who should receive a form. The exception to that is if you're using the measurement method look back policy and hopefully you have completed with our 4 steps. The 4-step helps you create that measurement method policy. If you're using that safe harbor, then you can rely on whether in the measurement period they really are full-time, not that 1-to-1 month determination. If a small employer is furnishing the 1095B forms, only enrolled employees need to receive the form. Doesn't matter whether they're full-time or part-time, whether they're offered coverage or not, only the people who are enrolled. Okay. Exceptions to furnishing a 1095C form to an employee. This is a bigger deal if you are using the regular method to furnish and you're not using the alternative method, but you still need to understand that if an employee is not a full-time employee in any month of the year, you don't need to give that to them. Or if an employee is in a limited non-assessment period for all 12 months in the calendar year. Now, limited non-assessment period, I know is a mouthful, and we aren't going to go down that rabbit hole because we're not talking about the employer mandate today, but we do have resources for you if you want to understand, or I can talk to you afterward if you want to understand. But I will have a chart that gives you some definitions and a couple of slides. But a limited non-assessment period basically is a period in which you're not offering coverage, but it's okay that you have because you have a legitimate reason for not offering, but it has to be the whole 12 months. Furnishing methods, you must mail or hand deliver or provide electronically, but if you want to do the exception in an electronic rule, you have to follow certain electronic notice rules. And that you're supposed to get each year. You need to get consent from each individual each year in order to receive the form electronically versus by paper. And that's separate. I know for those of you who know about electronic rules and consent on your other notices, like your annual notices packet and everything, that consent needs to be separate from the consent you get for the 1095 forms. However, here's an update. In the blue here there is a law that was passed. There were 2 that were actually passed at the end of December at the same time. And it changed the 1094, 1095 form reporting in some way. This is one of the second ways that it's changed. This law was called the Employer Reporting Improvement Act, again, signed by Biden at the end of the year, passed by Congress in the middle of December. The new rule is if you are going to use the exception to the rule and provide electronically rather than by paper, you do not need to get consent each year like you used to have to. You need consent once initially, and you can just continue providing electronically unless they revoke that consent. And then if they revoke it, then you have to do by paper until you get consent again. How many forms are furnished per employee? I have this question every once in a while. It's not a super common one, but you are not allowed to provide more than one 1095C form to them. In other words, you shouldn't provide one that covers part of the year and then another one that covers another part of the year. They can get one form. And I think that makes sense to most people. So we won't spend a lot of time on that. Okay, that was furnishing. Here's filing. Filing is when you're submitting the forms to the IRS. That filing must be electronic. And that changed, was it last year or the year before? It used to be that if you were filing less than 250 1095 forms, you could submit by paper and you weren't required to file electronically. Now, almost every employer needs to file electronically. There is an exception. I haven't talked to anybody yet for whom this actually applies, but the exception is small employers who are only filing less than 10 forms. And it's not less than 10 1095 forms. It's less than any IRS forms like W-2s, 1099s. If you're filing less than any of those IRS forms, then you can file by paper your 1094, 1095 forms with the IRS. Otherwise, you need to do it electronically. Okay, there is a hardship waiver option. If you are somebody who, for whatever reason, feels like this is a hardship and you can prove it, then you can submit Form 8508 and request paper filing. I will tell you, I looked into this once for a group, and I have that note here it starts with a factor. under here on the slide, first of all, you have to submit it at least 45 days before the due date. So it can't be like a last minute thing. But what they're looking for to show hardship is if the cost of filing the returns electronically exceeds the cost of filing the return on paper, which could be significantly more because there's a charge usually when you're using a vendor or a payroll system or whatever, an upcharge if it's payroll. Apparently, you need 2 cost estimates for software programming or third-party services or for preparation of the electronic files. So you would attach the bids, like this would cost us this much if we were to use this. And so we are requesting to be able to file it by paper because it's a lot more complex to do the actual submission process. That's why there's a charge for it, and that's why it can be expensive. When you're filing forms electronically with the IRS, you may choose, and we talked about this just briefly at the very beginning, filing with the assistance of a vendor or a third-party they're referred to technically as a third-party transmitter or a payroll system or other sort of platform. Or you can choose to actually submit. You might be populating the forms yourself, but you're using somebody else to submit. This is the case where you're populating the forms yourself and you're actually doing the submission yourself. If you are doing the submission yourself, you need to understand this can be a complex process and you need to prepare for it well in advance so that you can do it on time. Here's some examples. You must use XML format. And I know some people have a tough time transferring their form into XML format. I'm not a tech person, so you need somebody who can do that. I know people have had questions about that, but there's formatting directions for this and there's instructions. I would start with our summary that's entitled Filing Forms 1094, 1095C. It's a summary we have requested. That's the title of it right there. Request that. At the very end of that, it talks about electronic filing, and at the end of it, it provides some startup instructions, not line by line, but some detail on how to get started. And then there's some technical instructions. Your person in your organization that's going to take on this it's a technical issue. They're going to refer to this document that's called, and it's updated every year, Guidelines for Individual Reporters, called, let's see what it's called, Electronic Filers of ACA Information Returns. And it's 18 pages. There's 2 different kind of technical things. There's one that's really long and technical. This one is for those of you who are just trying to do it on your own. It's 18 pages and it can be very helpful. Okay, here's a tip. I'm going to have a couple tips here if you're filing electronically. If you're considering submitting the forms without a vendor or any help, or if you're not doing the self-service with Employee Navigator where it helps you populate the forms and then Employee Navigator submits it, you must complete 3 steps with the IRS before you can even have access. You've got to register to use eServices tool. You've got to apply for the TCC code, and you've got to do a test. So that's an idea. And that's kind of what we talk about in the summary we provide, is how to get you started into the system. And then there's the instructions from the IRS on the rest. But make sure that you start that technical process well in advance. If you decide, instead of doing the submission on your own, the filing technically, if your payroll company or reporting vendor or someone else, you need to make sure you clarify with that entity or provider of services on what they are or are not doing for you. I have talked to groups who thought that their provider or their system or whatever it was doing more than they actually were. And so you want to make sure that you clarify, are you populating the forms and filing with IRS and furnishing to our employees, or are you doing just part of that? So I have a list here of the options here, but that's the bottom line. You've got 3 kind of steps, and you want to make sure that you're very clear what they are and what you have to do still and what they are doing for you. Filing by paper, this is really not applicable anymore, but for the off chance that there's somebody here that is, you're going to print the forms in landscape format. You're going to keep the forms flat and not fold them when you put them in the envelopes for the IRS. You're going to number those packages consecutively. I don't think you're going to have to number them because you're going to have one envelope because you're going to have so many few forms in there. And you want to make sure you keep copies for at least 3 years and send it to one of these addresses. We're in Utah now, so you would send it to the Kansas City, Missouri address here if that were applicable to you. Okay, we're going to talk just briefly about federal versus state, but Kylie, do you have a question? We talk about the self and level funded small groups need to make sure that they are filing those B forms. There are some level funded TPAs, not self-funded, but level funded TPAs who are willing to file the forms for you, even though you are the one who is responsible for filing. I think that's just a service they have decided for a variety of reasons to do. So if you have a small level funded plan, you want to make sure you're checking with that TPA and to determine or whether they are going to be doing it or whether you need to. So thank you for reminding me about that too. Okay, federal versus state reporting, just really quickly. The ACA and the 1094, 1095 forms are a federal obligation, an obligation under federal rules. It requires most individuals to obtain health coverage. The individual mandate, remember that sheet, that slide we had with the 4 parts? One part was individual mandate, and I said it had changed a little bit. Well, originally, the ACA required most individuals to obtain health coverage for themselves and their dependents. Those of you may remember that. This is called the individual mandate. There was a change back in 2019 that did not remove the individual mandate, but it changed the penalty to 0, which basically means it basically cuts the heart out of it, right? So in essence, this no longer has any teeth. And so they're not checking individual mandate, but there are some states that as a result of this change decided to still have a state level obligation for people to get coverage for themselves and their families. And those states therefore also have some reporting requirements. And those reporting requirements typically include employers as well. So employees have to do something at the state level, and so do employers. So if you are an employer that employ somebody who lives in one of these states that has these obligations, you need to make sure that you are aware of these obligations and are performing that reporting. Now, I worry about people getting confused because they think, okay, we don't have to furnish these forms anymore to employees if we're using the alternative method at the federal level. Remember that this is a federal change, and the state level rules haven't changed at all. Those are all individually controlled by those states, right? So make sure that you still are following those state obligations. The states, just so you know, we have a summary on this. And if you aren't aware of this, make sure you ask your GBS team for a copy of it. So you know we have links and more information for each state. But the states are California, Massachusetts, New Jersey, Vermont, Rhode Island, and we also have the District of Columbia. So again, you want to make sure, actually, if you want to be technical, Massachusetts already had this individual mandate even before the ACA was passed, but most states did it as a response to the change at the federal level for the individual mandate. We are going to kind of zip through this because this is kind of something that's not on your head, but I just want you to be in your head right now because you're just trying to figure out how to populate, not how to correct. But there is a way to correct forms by paper and a way to correct forms electronically. For time purposes, we're not going to go into details, but no, you're going to get copies of the slides. Know that you have information in here if in the event you need to do that. But remember that the thing that you can do, number one, is if you find a correction, you're supposed to correct as soon as possible. And number two, my suggestion is always try to prevent. And I'm probably talking to the wrong crowd because you guys are all getting educated on how to do the forms and how to do it correctly. So you know how to check the forms before you file them so you don't have to go back and correct. My hope is that you'll all make sure that you understand how to check the forms so that you don't have to deal with problems after. Really quickly on penalties. Yes, I always get questions. What happens if we don't file? What are the penalties? How does that interact with the penalties under employer mandate? There are 2 separate penalties implicated here. We have penalties for failing to file or filing late under the reporting rules. It's technically, we've got section 67, 21, and 22. But we also have the separate penalties under employer mandate if you're failing to offer affordable minimum value coverage to at least 95% of your full-time employees plus their dependents. So understand that you can actually technically be imposed 2 different kinds of penalties for the same kind of issues. Does that make sense? So I have an example here where you could have two separate penalties, one for failing to file and furnish, as well as a penalty for failing to offer affordable minimum value coverage. So the point is you don't want to have to worry about that. Here's the information reporting penalties. They could be for failure to file or furnish, for incorrect or incomplete forms, for late filing. There used to be a good faith relief from penalty. There is no longer that good faith relief. That stopped in 2022. Update, the very bottom of this slide, one of the two laws that were passed and signed by Biden at the end of December also included a change here under the Employer Reporting Improvement Act. There is now a codified statute of limitations, meaning the IRS, and I don't think they were doing it anyway, but it's now in the law rather than any regulations. They can't go back more than 6 years to assess penalties. So, once you're past 6 years, you don't have to worry about that. Before it was, they could go back as far as they wanted. So that's good to have in the books. Here are the prices or the cost of penalties, because I always have people ask me, and it depends on how late you are or if you're incorrect or whatever. Here's your chart, but you can see the original amount when it was first was listed, but it goes up. It's indexed by inflation every year. And so you've got, and remember, it's per form. So it can add up. I will tell you the IRS is actively sending proposed penalty letters. There's a lot of health benefits compliance. You can be out of compliance and you'll never, quote unquote, get caught. And I don't suggest you don't do things because you might not get caught. I'm always recommending you get in compliance no matter what. There can be audits and other issues, but DOL audits are different. That's an individual team coming in, and there's a person coming in and asking for documents. And I don't know how many of you have had that audit before, but that's not fun. But under this particular rule, the 1094, 1095 reporting, because it's automated, this is extremely active. So if you are out of compliance and if somebody goes to the exchange to get a subsidy, which will trigger the penalty, you will be getting a penalty letter. It's not like you will fly under the radar. So you want to make sure that you are making sure you're in compliance. But those are the penalties for reporting. Here's the penalties for employer shared responsibility. Remember, there are, just as a primer, if this is new to you, we have a whole masterclass series on employer mandate. It's a four session class, but you'll get a lot more information. But basically, if you're a large employer or ALE, you fail to offer minimum essential coverage to at least 95% of your full-time employees and dependents, you would have an A penalty. If you successfully offer to all your full-time employees plus their dependents, but it's not affordable or doesn't meet minimum value, you'll have a B penalty. And that B penalty is cheaper than the A penalty because of the way it's calculated. And here is our chart that helps you understand how the penalties are calculated based on whether you have the A penalty, which is the first column, or technically the second column. And then the last column is the B penalty. There's that. And again, they are actively sending proposed penalty letters. Here's another update based on one of the two laws that were passed in December that changed reporting. Under the 226J letter, that is a technical name for the proposed penalty letter that will come to you if the IRS thinks that you have a penalty based on the employer mandate, not on reporting, and you had 30 days to respond to that letter. If you don't respond within 30 days, they have the ability to just assess the penalty automatically. I've never seen them assess it that quickly. Frankly, they're actually quite good to work with, but technically they could. And I would always encourage you really confirm that you want to make sure it's inside that. But now with the new rule, it's 90 days. So it gives you an extra 60 days to get your response in to help them understand why you may or may not agree with the penalty. So here's kind of a flow chart of how the penalty letter process works. And there is a letter that sometimes you might receive that feels like it might be a penalty letter, but it is not. It is actually from the exchange and not from the IRS. And it's actually telling you that you have an employee who is or employees who are receiving a subsidy, and that in the exchange. And that's important for you to know because that's what triggers the possible penalty. If you don't ever have an employee who goes to the exchange and gets a subsidy, for a coverage rather than them getting your coverage, then you will not be penalized. So you want to know. So it's not a penalty letter. You can respond to it or not. If you get one and you're confused about it, get a hold of us. We can help you understand what it is, but that's the bottom line on that. So that is our overview and all the rules. And now we have a little bit of time to talk about the actual 1094, 1095 forms. Now we're going to go over them mostly line by line. Some lines we're going to skip over quite quickly. The B forms we're going to go over really quite quickly as well, and spend most of our time on the C forms because they're a little bit more complicated. But the point of this is to help you understand how to check your forms and to know what to look for. And use these slides as a reference and a resource when you're doing that so that you can remember. You can look up these slides. I do it in order, chronological order, and you can look up the slides so you know how to check. So we're first doing the B reporting. The B reporting, remember, is for small employers who sponsor a self or level funded plan. If you are sponsoring an insured group health plan, you do not need to report. You are going to be using the B forms. Remember, you're going to file the B forms with the IRS and provide the 1095 B form to all enrolled employees. You also have the alternative furnishing process available to you, just like the large employers do under the new act that was passed in December. Here's what the B forms look like. The 1094B form is the cover sheet. The 1095B form is the one that gives individual information for the employee and the enrollees on the plan. Here's a closer look, but this is really simple. It's just asking for, this one is just the cover sheets asking for employer information. Here is the 1095B form. We're just going to go quickly over this. It's really simple, but we've got some lines that I pulled out here on the side. Line 1 it's the employee, so the responsible individual for that coverage for that family. Lines 2 to 7 is you're going to enter information for that person. And then in line 8, this is where you usually get questions if there are any. On line 8, you're going to enter code B if you're sponsoring a group health plan. G if you are offering an ICHRA. You're going to skip part 2. You're going to complete part 3, which is just employer information, really simple. And part 4 is you're entering the name of the covered individual and all their dependents that are also participants on the plan. So really super simple. So let's jump to the 1094, 1095C reporting. Large employer reporting, remember, you're going to be using the C forms. We just review really quick here what minimum value and affordability is. If you want to avoid all the penalties, you want to offer a group health plan that meets affordability and a minimum value. Minimum value pays a minimum. It's a plan that pays a minimum of 60% of the total cost, out-of-pocket costs, meaning you as an employer, your contribution toward the plan is at least 60%. When you're doing this calculation, you're not including the monthly premium. That's what that is. On affordability, the cost of the monthly premium is what we're looking at. So minimum value talks about out-of-pocket costs minus the monthly premium, and affordability addresses only the monthly premium, not the other out-of-pocket costs. So the monthly premium cannot exceed 9.5%, and that 9.5% is indexed every year, of employees' household income. Now, employers don't know, right, what employees' household income, total household income is, right? Because they might have other income coming in from other individuals. And regulators understood this, so they created in the regulations a safe harbor for affordability and give employers 3 options. You have the federal poverty safe harbor, the rate of pay safe harbor, and the W-2 safe harbor. We have explanation of how to determine your safe harbors, affordability safe harbors, in our step 3 of our step 4 process. So again, step 1 determines your size. Step 2 determines what day you were first exposed to penalties if you're large. Step 3 helps you determine whether your plan is affordable and meets minimum value. And step 4 helps you put together your measurement method policy so you can use that safe harbor as well. So in order to determine this, make sure that you are doing this. The ideal time to pick your safe harbor for affordability is at the beginning, just prior to your new plan year. So when you're making decisions about contributions, like we're going to charge employees this much and we're going to contribute this much, that is when you want to pull in your safe harbor and make sure what you want to charge for your lowest cost ACA compliant plan for single coverage meets one of those of safe harbors. I talk about the pros and cons of each one in those resources. So let's talk about the forms. This is what they look like. Some of you who use vendors or systems, you're filling in lines rather than filling in the actual, seeing the actual form. So I think it's helpful for you to see the forms themselves. The one on the left, obviously, is the cover sheet, and the one on the right is the 1095-C form. And again, you're going to complete a 1095-C form for all applicable full-time employees. Let's dive into the actual 1094-C form first. This is the cover sheet. This is the one that gives the IRS information about you as an employer and what you've done and what you've offered. This is the second page of that. That's part 3 that we had talked about. This part 1 and part 2 is what all employers of any type of funding complete. So if you're fully insured and if you're self or level funded plans, you're all completing this. If you have a self-funded plan, you're also completing this. And if you have a part of a control group, you're completing this, part 4. So let's jump into our line by line discussion. We have lines 1 through 6. Basically, you're entering employer information. So we're not going to spend a ton of time on that. But on line 7, sometimes I get questions on this. This is the name of the person who can talk from your organization, who can talk to the IRS if they come a calling. So you want to make sure that you have the correct person there. Skip lines 9 through 16 for most of you, unless you're a governmental entity. If you're a governmental entity, you can still skip this unless you're having another portion of your government do the filing for you. If you're not, which is in most cases you're not, then you're just going to skip it. So we'll skip that. Line 17, you skip. Line 18, you're going to enter the number of forms you will submit with this particular 1095-C form. So if you're submitting 200 1095-C forms, you're going to put 200 here. Line 19 is something I promised we would talk about. It's the authoritative transmittal. Is this the authoritative transmittal? Most of you are only going to file one 1095-C form, so you're going to say yes. You're only going to respond no, that this is not the authoritative transmittal if, for convenience, you wish to file more than one 1094-C form for the same entity. This is not for different entities of different control groups, different entities of the same control group. This is the same entity that has different branches and locations, and for whatever reason, they want to have them each do their own 1094 forms, you would say yes. But for 99% of you, you would say no. So 99% of you are going to say yes here. This is the authoritative transmittal or the authoritative cover sheet. Line 20, you're going to enter the number of forms you are submitting. Usually the number is the same as the one on line 18 that you're submitting with this 1094-C form, because you're only submitting one 1090-C form, but you're going to have a different number if you're using the authoritative transmittal issue and you're filing more than one 1094. So most of you can ignore that. So we won't spend a lot of time on it. Line 20 is important because you want to make sure you check yes if you are a member of a controlled or affiliated service group. This is referred to as aggregated group here on the forms, but that's also known as a controlled or affiliated service group. If you're not sure whether you're part of a controlled or affiliated service group, you want to make sure you understand whether you are. This will impact you as an entity for reasons, in addition to ACA rules, there are other various tax rules, so that you want to make sure you're complying with. So make sure that you know that you are. And if you don't know, to contact a tax professional to help you determine that. But you are going, if you check yes here, you're going to need to fill out a couple other parts of the forms. Okay, line number 22 is one that we have a lot of questions on, so I want to cover this. There are 4 boxes here on line 22. 2 of them are active, box A and box D. We're going to talk about each one of them. Box A is the one that creates the most confusion without question. It's called the qualifying offer method. And I have a bone to pick with the people who named this method, because it's confusing, because it makes you think that if you don't check the box, you are not in compliance, right? Because of the way they say it. It is not. You are going to check this box if you offered a qualifying offer and you intend to use this method. It's a specific reporting method. A qualifying offer refers to more than a compliant offer. You can not have a qualifying offer and still have a compliant offer. A qualifying offer must include more than what's required under the rules. The additional things I've got in blue here, offering to a spouse and using only the FPL affordability safe harbor. That's the change. Normally, you need to offer minimum essential coverage, which is a basic plan to the employee who's full-time and their dependents, but a spouse is not required under the rules. But if you want to have a qualifying offer, you need to also offer to a spouse. Under the rules with a compliant offer, you can meet one of 3 affordability safe harbors. But if you are using the FPL, the federal poverty level safe harbor, you and meet also offer to a spouse, you have a qualifying offer. And if you offer this all 12 months of the calendar year. So what do you get for a qualifying offer? What is this alternative method or the bonus for doing this? You get to leave line 15 blank. So line 15 on the form is the line where you insert the cost of the coverage for single coverage. So depending on whether that is a thing for you, then you want to use that method. You could have a qualifying offer and not use the method and not worry about it if you don't want to. Sometimes the vendors don't give you the option and they just complete it for you anyway. So, okay. The other box is box D, and box D is the 98% offer method. You're going to check this box only if you meet this level and you intend to use this alternative method. You meet or have offered a 98, you can use the method if you offer to at least 98% of your full-time employees. A compliant offer is offering to at least 95%. So this asks you if you're going the extra mile and you can confirm that you've offered to at least 98% of your full-time employees and dependents, then you have a 98% level and you can use this method if you want. So you don't have to do anything else. You can offer to employee independents. You don't have to offer to spouse. You can use any of the 3 affordability safe harbors. It does need to meet minimum value. But the bonus for this, to me, in my opinion, is a much bigger deal because you are excused from completing this column. This column is a little tricky and you have to do some work to get these numbers right. So I think it'd be great to be excused from that. So if you can qualify for this method, I would check the box and leave that column blank. And we'll talk about that column when we get to part 3. Line 22, tips to avoid common confusion. Remember these, I think I've made it clear already, but remember these methods are optional. Even if you have these and you meet these, you don't have to use them. Totally up to you. It's no problem if you don't use them. You have assuming you have a compliant plan and you're offering an affordable minimum value coverage to your dependents, full-time employees and their dependents, you're fine. Okay, so let's talk about part 3 now. This is the section that has that whole matrix. This column A is asking you whether you offered minimum essential coverage to at least 95% of your full-time employees and dependents. So it's worded a little bit different. Confusingly, it says minimum essential coverage offer indicator. Basically, it's saying, did you comply with part A of the rule? Meaning, did you offer to at least 95% of your full-time employees and their dependents? If you did, you want to put yes here. Hands down, this is not scientific, but this hands down is the most common mistake employers have made on this. They put no, even when they did offer to at least 95%, and they get a penalty letter. And then they have to respond to the IRS when they get a penalty letter and say, oh, you know what? We actually did offer, we misunderstood the rules. Here's what we should have done. We should have put, no instead of yes. And back then, that was a transition rule that allowed for, unintentional mistakes. Now we don't have that rule that even if it's an unintentional mistake, you still could be penalized. So make sure that you check that when you're checking the forms, whether you're doing it yourself or a vendor's doing it or using a platform. that says yes if you actually did comply with that. Other than to say that when you're calculating 95%, there's a certain amount of full-time employees you do not have to include. So if you're bordering on that 95%, you want to make sure you're aware of that rule. Here is our limited non-assessment period. You don't have to include employees who are in a limited non-assessment period. And here I cut and pasted this and kind of changed the wording a little bit so it made a little bit more sense. But this basically is a no penalty period. And if you have an employee in that, you don't need to have offered. But hopefully you're well within 95%. You don't have to worry about this limited non-assessment period. Okay, column B, we talked about before. This you are excused from completing this if you use the 98% reporting method. But this is, you are including in here your full-time employee count for each and every month. So you've got to enter the number of full-time employees for each month. And when you're calculating that, you've got to, that's a little bit tricky because you've got to make sure that you are capturing everybody. So if you're using your step 4 measurement method policy that we helped you create, you do not have to include employees in this count who are in that method, even though they may have worked full-time in a particular month. If their average is under the 130 hours that we talk about when we talk about those rules and that method, then you don't have to include them in the count. But you want to, that it's just a bit of a pain column. So column C is the simple column. This is a count as well, but you're just counting belly buttons. You don't have to figure anything out, whether they're full-time or not. If they are on your books in that month, you count them. So you're counting belly buttons basically, and you can pick whatever day of the month you want to count your employees, but it has to be the same day every month. So if you pick the first day of the month, you have to use the first day of the month. B, the aggregated group indicator. This is only for those who are part of a control group. They use aggregated. Remember, aggregated in synonymously with control group. So if you said, yes, we're part of a control group, you're going to check the box for the month in each month that you were part of that group. And this is transition relief that doesn't exist anymore, so you can leave that blank. Lines 36 through 65 are the equivalent of a list of the entities that you will have or part of a control group with. So in other words, if you have, the gentleman here said he had 5 other entities, so you're going to list the 5 other entities by size, the largest one at the top, the smallest one at the bottom of the list, and their EINs. Okay, so that's the 1094C form, and we're going to move on to the 1095C form unless we have any questions. Yes. Question is, do we only list the entities that are like above a certain number? And the answer is no. You are going to, no matter what their size, you're going to list the entity if you're part of a control group. Yeah, so the different entities, the 1094Cs will, each of them will list. So the other entities will have you in this column and you'll have all of them in this section. Does that make sense? So that they'll be connected. Let's move on to the 1095C form. Okay, here's your 1095C form. This is what it looks like. For those of you who are fully insured, this is all you have to fill out. Whoops, sorry. If you have a self or funded plan, you're also going to fill out part 3. This is what it looks like. Employee and employer information, lines 1 through 6, super simple. You want to make sure that you confirm the Social Security number of the employee. Lines 7 through 13. The point here is to make sure you use the same EIN number for employees who get paid under that EIN number. So if you're part of a control group, make sure that you're assigning or the proper employees under the proper EIN and not mixing and matching them. Make sure you also use the same employer address on your 1094 form as you do on the 1095 form. Age, this little section right here on the skinny line on part 2. This is only applicable to ICRAS, so you can ignore that if you're not offering that. And I think all of you are not offering that. This, though, you do need to complete. This is the plan start month. It's a 2-digit number. It is not when that employee started on the plan or was enrolled on the plan. This is your plan year. So if your plan year is January, it's going to say 01. If your plan year starts in October, it's going to say 10. Lines 14 to 15 and 16 are the heart of the forms, as you've probably figured out if you've done this before. If you haven't, this is the key. Lines 14, 15, and 16 have designated codes. At least lines 14 and 16 do. The regulators assigned codes to lines 14 and it's called series 1 codes, and they assign codes for line 16, which are referred to as line series 2 codes. We have a cheat sheet for that. That's just a PDF that you can print out that we copied and pasted, but then I kind of messed with the wording to make it more clear because some of the wording isn't clear when you look at the regulations. So ask us for that cheat sheet if you like, because you want to make sure when you're checking the codes, you know which code is appropriate and you understand. So this is a big area where you're going to be checking. You're going to be checking for accuracy for each of the employees. And then line 15, we talked about it just briefly, but line 15 is the line that lists the cost of the coverage for employee single only. And it doesn't matter, we're going to get to that right now, but it doesn't matter what they enrolled in. It's just what the basic cost is. So line 14, this is information you're giving to the IRS about what was offered to the employee. And there are a group of codes on the series 1 that are at the top. There's about 6 of them that you could choose from that all list whether the employee received an offer of coverage, whether it was minimum essential coverage, whether it was minimum value, whether spouses or dependents were offered. You'll choose the appropriate code from that list. The way to avoid a mistake here is only report an offer for a month if an employee was eligible every day of that month. So this is kind of a common question. If somebody is eligible for the plan, and most people from I understand you are loading them on the first of the month every month, but some groups don't do that and they load them on the middle of the month. You can't count that for purposes of reporting. You have to wait for the full month of eligibility before you can say they were eligible and they were offered coverage. You do not want to leave a box blank on this line. There's a code that applies for every situation, so do not leave any blanks on line 14. The most common codes are the 1A through 1F, which are the different kinds of offers, and 1H is the no offer of coverage. But here I've got this on 2 separate slides because it didn't fit right. But here are the codes for series 1. You can see MEC providing ME, MV offered to employee only, offered dependents, not spouse, and so on. But I think the PDF where it's all on the same page is more helpful. So ask us for that. And then we have a lot of added codes that were added when the ICRA came into play. But here's some frequently asked questions that I want to make sure you're aware of. We offered affordable minimum value coverage, so I can use code 1A, correct? We talked about this before. This was line 22. There was that box A and box D. If you, and they're asking if you can check that box. And if you check that box, you would put code 1A in that line. So it depends. Again, this is just a repeat, but a qualifying offer is different than a compliant offer. It's even more generous. You do not need to use this code. It doesn't mean you're out of compliance if you do not use code 1A. There are plenty of other codes, 1A through 1F, that are fine. So will I be penalized if I don't put code 1A in line 14? No, you will not be, just based on that. You can of course offer an affordable plan that does not meet the code 1A and you're fine. So code 1A is an offer that goes beyond the ACA employer shared responsibility requirements or employer mandate, and you're fine if not, as long as you've offered a compliant plan. Again, line 15 is the amount that you charge for single coverage. It's the monthly premium cost for one or a single person under your most affordable ACA compliance plan. If you offer more than one plan, you're going to pick the one that still meets minimum value and affordability and put the cost for that. Line 16 is a really important code. You do not want to leave any blanks here, but you also should not put a code in if there's not an appropriate code. So if you have messed up and there is not an appropriate code there, that's fine. I'm not telling you to lie, but I will tell you that it's important to have populated a code here. So generally, the codes for this report on whether you offered the coverage or not, and if you did offer, did they enroll? So the super simple way of explaining this is if they enrolled, you're going to put 2C in because that's the enrolled in coverage. And if they didn't enroll and it met a safe harbor, you're going to put the safe harbor code in that line. So those are the two most common codes that you're going to put in there, either 2C, they enrolled, or 2G, 2H, or 2F, depending on which safe harbor you chose. There are other options in there too as well, but you want to make sure you do that correctly. And here is a list of the Series 2 indicator codes. And again, you'll want to use our PDF instead, but 2D I want to focus here on. 2D is a code that will not get you in trouble if you have. There's a bunch of here that you can put a code in there even though you didn't offer. There's a legitimate reason for not offering. And 2D is the one that includes waiting periods that are appropriate. So they weren't on the coverage yet, but they were in a waiting period. And so you can use 2D, but you need to make sure you follow those rules correctly. Another frequently asked question is what Series 2 code applies if an employee is offered coverage but does not enroll? We covered that. That's the affordability safe harbor. May an employer use code 2A? That's kind of created some confusion too. That code says they were not employed. If the employee worked only a couple of days in that month, no. If they worked even 1 day in a month, you need to use code 2A. Code 2A says it's an employee is not employed during the month, and it's only for employees who did not work any day in that month. I hope I said that right the first time. What if an employee was eligible for group health plan but was in a waiting period? We talked about that. That's code 2D. Make sure that you have the appropriate code 2D. If you're using a waiting period that's too long, it's not appropriate to put it in for those months, but we can help you with that if you have any questions. Code line 17 is just for ICRAs, so I don't think that's going to apply to most of you. But here are another couple of really common questions on this line or on this section actually. How do I code correctly for COBRA? COBRA is kind of tricky. You have to divide, first determine whether that employee is a current employee or a past employee, because the answer is different. If they're a current employee, you're going to treat them like it's a normal offer of coverage. But if they're a past employee, you're going to say there was no offer. 1H is a no offer code. Even though they're on COBRA, you're going to put 1H. And on line 16, you're going to put 2A, not an employee. So use these two slides as you're not going to remember this, well, at least most likely. So just refer to these slides again when you have that question. Part 3 is only for employers who sponsor self or level funded plans. You make sure you want to check that box right there you see there on the right hand side that says these are for employees that were enrolled. So you don't fill this out if they did not enroll, but you do fill it out if they do, and you're going to put the employee and anybody else in their family that is on the coverage as well. Just really quickly on columns A and C and E, it's pretty self-explanatory. You're putting the name, their social security number, or their date of birth. Here's a big change too. This was a big kind of pain point for some employers because you have to put a social security number for dependent, and sometimes you don't have that number or you have an incorrect one. Or one of the laws that was passed in December. This one, it was the Employer Reporting Improvement Act. Again, this codified the rule that says if you do not have a social security number for that dependent, you may officially use the date of birth. So regulators were allowing you to do this anyway, but it's now in the rules and not just in regulations. So it's very clear what is and is not okay here. And then in column E, check the monthly box if individual was covered for at least 1 day in that month. So they may have come on in July, so you're not going to check a month before that. Do I need to complete part 3 for all of our full-time employees? No, you do not. You're only completing part 3 for the full-time employees who were actually enrolled. You need to give a form to all your full-time employees, every single one of them. But part 3 is only completed for those who are enrolled in your plan. Okay, what about offering a self-funded HRA? You may have a self-funded plan, group health plan, and an HRA, which is also considered self-funded. And if that's the case, your self-funded group health plan and your self-funded HRA, you don't have to fill out 2 forms. You're fine. You just fill out part 3. If you sponsor a fully insured group health plan, you're not going to complete part 3 if employee enrolls in both the group health plan and the HRA, but you complete part 3 if the employee is enrolled in the HRA but is not associated with your group health plan. We talked about this before under the small. If they are in your HRA, but it's associated or integrated with their spouse's plan, then you complete that part. Does anybody have any questions? Yes.